Hi, it's Josh, and today we're going to talk about something that's been developing with INEOS Automotive, and it's not particularly great news. We're looking at layoffs, financial struggles, and some major restructuring that tells us something about where this company's headed. While it's not all doom and gloom, the news affects everyone who's been following the Grenadier story or is thinking about getting one. So here's what's happening. INEOS Automotive just announced that they're cutting several hundred jobs from their global workforce of about 1,850 people. Now, when I first heard this, I wasn't entirely surprised, but the scale is pretty significant. We're talking about a large percentage of their staff across multiple locations, their London headquarters, their engineering center in Germany, and their factory in France. Now, the good news, if you can call it that, is that the people actually building the Grenadiers and the quartermasters at the Hambach factory aren't affected by these cuts. About 1,200 people work there, and their jobs are safe for now. But this still tells us something important about where INEOS sees their priorities. Let me break down the numbers for you because they paint a pretty clear picture. INEOS made a 290 million British pound net loss last year. That's around 380 million US dollars. That's after a 323 million pound loss in 2023. So we're looking at over £500 million losses in 2 years, or $650 million. Now, that's a lot of money, even for a company backed by Jim Ratcliffe's billions. But here's where it really gets interesting, and this is where it gets a little complicated. Sales actually rose 40% last year, and revenue jumped 58% to £789 million, a little over $1 billion, which comes from the required UK company filings since INEOS Automotive doesn't publicly release unit sales. So they're selling more cars, making more money, but still losing hundreds of millions. And that tells you everything you need to know about their cost structure and the challenges of being a startup automaker. Now, INEOS is saying these job cuts are part of a reorganization to focus on the frontline operations and simplify its head office. That's corporate speak for we hired too many people and now we need to cut costs. They're also shifting emphasis more towards sales in key markets, particularly the US, where it represents about 60% of their sales. Speaking of the US, this is also a big part of their problem. They're still dealing with some serious tariff issues. The new tariffs imposed by the US on the EU-built vehicles pushed the duty on passenger Grenadiers up from 2.5% to 15%. The quartermaster pickup faces an even worse 25% tariff because of something called the chicken tax, which is a holdover tariff from the 1960s. These aren't small numbers when you're trying to make a profit on vehicles that already have tight margins. This is why INEOS is once again actively searching for a US production location. CEO Lynn Calder confirmed this to the Financial Times, and it makes a lot of sense. If you're going to sell most of your vehicles in the US, you need to build them there too to avoid these crushing tariffs. But here's where it gets really interesting and concerning. This move raises serious questions about the viability of the Hambach factory in France. That facility has a capacity of 33,000 vehicles on 2 shifts. And they're certainly operating well below that capacity as they currently only run 1 shift, as I learned firsthand during my tour of the plant this past summer. If they move the Grenadier production to the US, what happens to Hambach? But moving past that, let's talk about what's driving these problems, because it's not just INEOS. The entire automotive industry is going through what I'd like to call a perfect storm right now. You've got supply chain issues and haven't fully recovered. Raw material costs are through the roof. There's massive uncertainty about electric vehicles and government regulations. INEOS has delayed their planned electric Fusilier SUV to 2028 or 2029 because they're waiting to see if the EU will include some hybrids in a potential revision of the 2035 ban on internal combustion engines. As CEO Lynn Calder puts it, we're too small to spend a huge amount on product development, then to find out we can't produce it, we can't sell it in key markets. And that's a brutally honest assessment, and it shows you the impossible position small automakers are in right now. They have to comply with emissions regulations, but they can't afford to develop electric vehicles that might not sell. And if they can't predict what the regulatory landscape will look like in 5 years, they're in a tough spot. Here's another piece of the puzzle that's really concerning. INEOS Automotive is struggling with debts of £3.25 billion, or $4.28 billion, owed to other INEOS Group entities. Interest payments alone totaled £243 million last year, while administrative expenses were £315 million. So even before they start building cars, they're paying nearly £250 million in interest. The debt structure is actually pretty common in corporate setups like this, where one division borrows from another, but it creates a lot of financial pressure. Every decision has to be made with these massive interest payments in mind. Now, let's put it into perspective. INEOS Automotive isn't the only company struggling. In a recent article, The Guardian points out that Jim Ratcliffe's broader empire is under pressure. They've closed chemical factories in Germany, cut jobs in the UK, and are filing anti-dumping cases to block cheap imports from China. The credit ratings agency Fitch and Moody's have raised red flags about INEOS Group's debt levels. But here's what I find most telling about the whole situation. INEOS says these staffing reductions reflect their transition from its engineering phase to a market-focused business. That suggests that they don't have any new models coming out anytime soon. They're basically saying, we're done developing, now we need to focus on selling what we have. For current Grenadier owners and people thinking about buying one, this creates some interesting dynamics. On one hand, if you've been waiting for the next generation or major updates, you might be waiting a while. But we've already speculated on that. And on the other hand, this focuses on sales and efficiency might actually make the current Grenadier a better value proposition. The company is also opening a new Americas headquarters in New Jersey, which shows they're serious about the US market. But it also shows that they're betting on American sales to keep the company afloat. Now, I want to address something that's been bothering me about the coverage of this story. A lot of outlets are treating this like INEOS is on the verge of collapse, and I don't think it's fair or accurate. Yes, they are struggling financially, but they are backed by a £61 billion parent company. Jim Ratcliffe didn't get to where he is by giving up on projects at the first sign of trouble. What we're seeing is a company that grew too fast, hired too many people, and is now right-sizing for the reality of being a niche automaker rather than a mass market player that they might have hoped to become. That's not necessarily a bad thing. It might actually make them more sustainable in the long run. The real question is whether they can execute this transition successfully. Can they cut costs without losing the engineering expertise that makes the Grenadier special? Can they build a sustainable business around selling 30 to 50,000 vehicles per year globally instead of the hundreds of thousands that they may have originally hoped for? I think they can, but it's going to require some tough decisions and probably some more painful cuts along the way. The automotive industry is littered with companies that had great products but couldn't make the business model work. So what does that mean for all of you? Well, if you're thinking about buying a Grenadier, I'd say the fundamentals haven't changed. It's still a great vehicle. It's still well built, and INEOS is still committed to supporting it. But you might want to think carefully about dealer support and parts availability if you're in a market where INEOS doesn't have a strong presence. If you already own a Grenadier, I wouldn't panic. The company isn't going anywhere. They're clearly focused on making the business sustainable, but it's worth keeping an eye on how this restructuring affects things like warranty support and parts availability. The bigger picture here is that we're watching the automotive industry go through a massive transformation, and companies like INEOS Automotive are having to adapt in real time. It's messy, it's painful, but it's also necessary if they want to survive and thrive long term. I don't see INEOS Automotive going away. At absolute worst, perhaps the company might be acquired by a bigger player in search of a quality niche brand. Even Land Rover has had 5 major owners throughout its history, including BMW, Ford, and Tata Motors. So for those of you who've been sitting on the sideline wondering if the INEOS Automotive will be a survivor or a failure, you're right. And it doesn't likely matter much if the product produced is good. Somebody, including a corporate entity, will want it. But for now, let's leave the reins squarely in the hands of INEOS and let them continue with their drive and innovation to take the company to its next level. What do you think? Are you concerned about INEOS's financial situation, or do you see this as a necessary step towards building a sustainable business? Let me know in the comments, and consider subscribing if you'd like to be kept up to date on news and progress at INEOS. So, thanks for watching, and I'll see you in the next video.